Hi, everyone. It's a great pleasure to host this very exciting panel on the future of venture investing. We have a very exciting, high-profile lineup of great investors here. I'll let them introduce themselves in a short while. First, about me, my name is Xiao-Xiao. I'm an operating partner at KKR, one of the leading investment firms in the world with 600 billion assets under management. I lead the digital asset strategy, where we invest, amongst other things, into some of the best managers in the space. Very excited to host this panel, and I'll pass on to Akshat.
Thanks. Hey guys, my name is Akshat. I'm head of investments for Maelstrom, co-founder, partner, which is the family office of Arthur Hayes. We've got a liquid strategy, venture strategy, and we're getting into a new space that we're happy to talk about at the rest of this panel.
Yeah, hi everyone. My name is Kelvin Ko. I'm one of the co-founders of Spartan Group, which is a global advisory and investment firm. And I focus on the investing side. And like what Akshat does, we have a liquid fund and we've got 2 venture funds.
Hi everyone, my name is Ella. I'm head of managing partner of Easy Labs, which know formerly Binance Labs. So basically, we're managing the money from CZ's family office, and we have over 10 billion of asset under management. We do incubation and also liquid strategy and direct investment.
So my name is Viktor. I am the founder and CEO of RockawayX. We manage roughly $2 billion now. Half of it is investments and half of it is engineering. We are now Dubai-based since last year. So 45 people and 10 people are actually based here in Dubai. We are opening Solana City next week together with the foundation.
Excellent. So just diving into the whole space, I'm sure everyone is in some way related to the crypto venture investing space. But if I sort of take a helicopter view on the entire market, right, of where you could, as an investor, invest into this. Right now, the latest estimates that we have on the total market is that roughly there's about 70 to 80 billion of total AUM in venture investing in crypto. So all of the cumulative fundraising that has been done. If you contrast that to the sort of public and more liquid side of things, we see about 15 billion of liquid directional AUM, so much smaller. And then about even smaller, 5 billion AUM in liquid market neutral strategy. So these are essentially the 3 types of investments you could do. If you compare that to the traditional markets, it's the other way around. So it's actually 20% of venture illiquid and 80% is actually hedge funds and liquid. So crypto is actually completely lopsided in this space. If you look at the trends then in the private side of the markets, 2024, we had roughly 10 to 15 billion of VC funding deployed into the sector. And that's about 20% increase from 2023. But it's about 50% down from the peak in 2021. So we are sort of in this phase of going down and picking up again, but still far away from the peak in 2021 in terms of total deployment into the space. That invites me to the question, right? There's a lot of things on Twitter and people said, right? There's questions about, is this venture investing model in crypto still sustainable, right? And I'm going to just formulate in a more provocative question. Is the venture investing model dead in crypto? Because some of the questions and challenges we've heard is around, successful founders have found alternative ways to bootstrap and found the biggest examples, Hyperliquid. Echo is an investment platform where you don't need VC investors necessarily. And then now you also have the MicroStrategy and UPEXIs, right? That buy directly sort of liquid tokens. So what is your sort of view on these challenge? Maybe I'll start with the, Viktor.
Yeah.
Sorry.
So I think it's just a natural progression of the market where we are versus TradFi. But maybe just for the audience to take away like one point, we are actually shifting our strategies more from VC towards restructuring. So the restructuring of liquid tokens. So for example, we acquired IDLE protocol. If you remember, it was like an old protocol generating yield on DeFi on Ethereum. We acquired IDLE. We are restructuring, so sunsetting the IDLE token, restructuring and relaunching the platform as Pareto. Second example is reinsurance. Names.com, maybe some of you heard about it, is a reinsurance protocol initially on Ethereum. we acquired names.com, sunsetting the token, rebranding to Onri, and launching on Solana.
Ella, I mean, you have a huge AUM. I mean, you invest in multiple strategies. How do you balance this sort of challenges? Are you seeing similar challenges, and how do you sort of rebalance the total portfolio?
Yeah, so first of all, I don't think venture investing will never die. There are so many ventures, and the venture investors fiduciary just to capture the upside and create the value in the process, and by helping founders to provide additional value to help them grow. So for Easy Labs, we established 7 years ago with the mission to help the whole ecosystem to grow. So our belief is that when the ecosystem grow, everyone will get benefited. And so we invest a lot of time into incubation. Not that part don't acquire a lot of capital, but the outcome was just the best. We see the best multiples come out from our incubation. So basically, there's Polygon and Injective and Ethena, all those projects actually come out from Easy Labs incubation program. But we have such a big AUM to deploy, right? We also see there's so many good projects that's out there post TGE. We have potential to bring them to the next level. That's the reason we establish our investment strategy. We call it dumbbell. One side, we deployed massively into a very early day one founders and try to be the first check-in. And on one side, when the project, they grow more mature, they have good product, they have the good fundamentals, we bring our capital to help them to grow to the next level. We hope in this way, we helped the whole ecosystem to grow robustly.
And I would highly recommend to founders to work with Easy Labs because they never sell. So, for example, 1inch, we co-invested together. Some VCs sold already. We haven't. Together, we haven't.
Thank you. Yeah, we are really long-term holders. I think this is very closely tied to the vision of CZ and the Binance co-founders to try to long the whole ecosystem. So typically we hold the token through the cycles.
So I agree with Ella. I think venture investing will always have a place in crypto, and the reason is because venture fund investors, we invest across the cycle, right? We are not only investing when the market conditions are good, right? Even when the market conditions are terrible, when we're in a bear market and there's lack of funding, the venture investors step up to provide the capital and to help these founders to launch, right? So I think there'll always be a role for VC capital. But I also spent almost 20 years in traditional finance. And if I look at the way that the crypto market is structured today versus the equity markets, the big difference, as you said, is that there's a lot more capital on the liquid side as opposed to venture in the traditional markets. And if I look at the crypto landscape today, what is missing from the investment landscape is the presence of these long-only funds, right? Like you have the T. Rowe Price, Capitals, and Fidelities of the world in the traditional space, and we don't have the long-only funds yet in the crypto investing landscape. So I think they will come. Once regulations are in place, I think you'll see all of these traditional funds come into our space. But it may take 1 or 2 more years before they come. We may also see some crypto-native investors eventually sort of leaning towards a long-only model, right? Where today, I think most of them are structured as a long-short type of strategy.
Akshat, I mean, Maelstrom has a liquid background, obviously, right?
Yeah.
How has the sort of venture part of the portfolio evolved?
Yeah, so Maelstrom was founded in 2023, and that's kind of the depths of the bear market. For us, we see it as very much a cycle-dependent decision. So wherever we are in the cycle, that's where we make our bets. So in year 1, we were focused on venture. That was kind of like, valuations were low. A lot of the superfluous business models and founders had been washed out. And you had really high conviction, high quality founders building at that time. In 2024, things started picking up a bit. We added on our liquid strategy at that time. And now here we are in 2025, not really doing very many venture checks. and starting to build out new strategies. But I think, to answer your question more directly, is venture dead? I think venture is just going to evolve in crypto, right? Because a lot of folks are tired. Retail, like everyone who's actually the revenue model for all of us on the stage here, is tired of the same strategy of VC-backed tokens, right? The insiders get in first. Everyone else is basically exit liquidity. The SEX is charged their 5 to 10% fee. The rent seeking, I think people are tired of that. So we're just going to have to evolve as an industry, and that's going to start with how venture investing is done. Yeah. So we'll see how that plays out.
And maybe Xiao-Xiao, to one point, 80 billion you said for VC, 50 billion for hedge funds, and 5 billion for private credit.
15,
I think
right?
15, 1-5.
15.
For
so I think
direction.
it's also like a blurry line because many VCs are actually allocating to liquid. So our newest fund, we just announced 125 million raised, 30% goes into liquid strategies. So yeah, there is a blurry line.
I think maybe here a question for Viktor and Kelvin, since you're managing essentially external LP capital. One of the challenges of the venture model, I'm an allocator, and talking to some of the other LPs and allocators, they see the outsized return potential that this brings, but there's an increasing need for DPI and liquidity, and that's sort of a main differentiator amongst the sort of asset managers. How do you reconcile sort of that pressure, right? Selling pressure as well as sort of
so I think,
for liquidity.
Look, we have 80 LPs, 80, for altogether maybe $400 million raised across all the funds. So the two VC funds and one private credit. Especially today, LPs are looking for DPI. On the previous fund, we had 2.1x DPI when we started to raise second fund, so that helped. But myself, I invested into 34 other VCs, crypto VCs. It's a good sample size. Only 4 of them have some DPI, so only 10%. If we take that sample to the overall market, hundreds of VC funds, it's definitely a problem. So there is a more and more shift from VCs to just returning cash.
But I think part of the problem is that when we first started doing VC investments back in 2017, right, in the crypto space, the deals typically had no lockup, no vesting, right? So you invest, and when they get listed, you have full liquidity. I'm not saying that's the best model, but at least the fact you don't have the problem we have today, where you have a lot of tokens that have this high FDV, low float problem, right? And some of the floats are even as low as, I heard yesterday from somebody, there's a particular protocol that's got 0.5% float. That's bullshit, right? So you have this problem in industry, and the problem's been created over the past few years because of the new vesting schedule that we typically have today, where it's 1 year lockup and multiple years of vesting, right? And not a lot of float. And so you don't get price discovery, right? When you don't have price discovery, you have valuations that don't make sense. And so retail investors are not stupid. They look at these valuations and it's like, it makes no sense. I'm not going to buy this token, right? So we created a problem for ourselves, right? So I think we need to evolve the model, as Akshat said, right? To make sure that the vesting makes sense, the lockup makes sense, and there's enough liquidity for price discovery, right? And from a venture fund standpoint, part of the reason why the returns or the lack of DPI exists is because of this long vesting schedule, right? And when we launched our first venture fund in 2021, we certainly weren't anticipating such long vesting schedules. Now, fortunately, when we set up the fund, we created a 5-year fund plus a 2-year extension, so we can manage the vesting. But it just means that you're not going to get DPI so soon. Our first venture fund was launched 2021. We took 3 years to deploy, and then now we've just made our first distribution, and we're going to continue to distribute. So the DPI will come, but it just take a little bit longer than expected.
That's a great segue into the next question, because you're leaders in this sort of crypto investing space. And given these challenges, right, both from the retail pushback, LP sort of pressure, and then founders sort of adapting to new forms of fundraising, how are you adapting your operations or strategy of how you sort of invest in light of these challenges, right, to kind of continue to be successful? Maybe Akshat, let's start with you.
Yeah, as a family office, we're very flexible, so it doesn't really impact us operationally. But I think, just zooming out a little bit, venture is going to get harder in crypto. Because before, the hardest part of venture was getting an allocation. It was more important than the actual quality of the company and your diligence. That's evolving. Now, especially with these new like fair launch models, you look at Hyperliquid, right? They didn't need the sexes to collect their fee in the middle for no reason. It's going to get harder and harder for VCs because now you're going to have to actually compete directly with retail. They have as much information as you, hopefully, in an ideal world, eventually. And it's not going to be about who do I know, who can I get an allocation from. It's what is the quality of this project, what's the trajectory look like, and it's going to get a lot harder. You're going to see a lot of funds get washed out in that process.
Yeah.
Viktor?
I would say, you know, controversial view. No more billion-dollar protocols. I think the VC fight of, the next L1, it's over. I think the game is now given. And it's basically Solana, potentially some super fast EVM. My bet is Monad, but I love Mega ETH. And of course, Ethereum, I think, will recover with ZK VMs and base layer rollups. But I think that's it. Now, I think the VCs have to understand that 100 billion protocols are over, and they are investing into DeFi and other use cases where the most successful protocols are billion-dollar companies. So I think the 2017 game of 200, 300,000 tickets into like many L1s, which will become 100 billion protocols, it's over. So there is fight for ownership. And so that's why VCs are now adding more and more value to the founder, DMM, designated market maker, running the validators, providing liquidity to their protocol to increase TVL, running solvers, because you really want to be the key partner of the founder and maximum to be aligned with the founder on also the token ownership. I think that's what's been changing.
Ella, you can bring obviously a lot of value, right? Given the background to the founders. How is your approach changing, in venture investing, both in terms of valuation, maybe how you do diligence? I generally love to hear like how you guys actually diligence about which companies to invest in and which ones to pass on, actually.
Yeah, so good question. Actually, overall, Easy Labs, we're trying to focus on long-term founders. And how do we identify long-term founders? We have a strong focus on why the founders are building this, why this matters to them, and whether or not they are driven by some short-term financial returns, or they want to solve a big enough problem, and do they have the right skill set and background to solve it. We ask a lot of why questions when we talk to the founders. And another way we try to solve the problem is try to add value, because I myself was a founder for a few years, and I really get humbled being the founder role. No founder is perfect. No founding team is perfect. We're trying to add value to help them make up the capabilities they probably lack. There are a lot of tech co-founders, they lack of the understanding of how to raise funding, how to go to market. There are also some founders are very good at sales, but probably they lack of CTO. So we're trying to build a big talent network to try to help them solve the problems and incubate and help more projects to be healthier. So we interviewed a lot of founders. The two main pain points for them is when they have a good enough product and go to market. And another one is to recruit good enough key people. So those are the areas Easy Labs in trying to build an internal talent pool to help our over 200 portfolios. And I have a third point is really that our whole team, I think overall, we're very optimistic for the future. Even there's cycles, we see we're at a very interesting and critical moment that the combination of Web3, blockchain, and AI will really significantly change the human society. But there are so many big problems haven't been really solved yet. The data privacy, data ownership, and how to make everything secure enough yet transparent and fairly distributed. As long as there are big enough problems to be solved, and there are a lot of builders, we see a bright future that we try to join them to build.
So I had a couple of more points. I agree with a lot of the comments that Viktor mentioned earlier about the infrastructure layer versus the app layer. And I think and I've said this many, many times, right, that till today we still don't have many apps that is widely adopted, right? And people keep asking, so who's using crypto? Right, still asking that question. I guess now we have stable coins, but really we need more applications. We need more application builders, right? Because all of the money that we've poured into infrastructure over the last few years is great, but if we don't have 1 billion users in crypto in the next 5 years, then crypto is meaningless, right? So we do need to invest at the application layer, and we've been investing at the application layer since we launched our first venture fund in 2021. Focusing on DeFi, and in 2022 we launched a fund that's focused on gaming. So we're doing our part, and I hope many of the other venture funds will do the same and start taking more risk and back some of these great application developers that want to build real stuff on crypto rails. In terms of how we add value as a venture fund, I mean, we do a lot of things for our podcasts. We help them with marketing, we help them with liquidity provision, connection to exchanges, market makers, so on and so forth. But I guess the thing that I find most satisfying is, earlier today I met with 2 of our portfolio companies before coming here. And the moment I met them, they came to me and they gave me a hug. They gave me a hug and they said, we love you. You were the first one to invest in us, to believe in us. And market conditions are difficult and we're still here building. And, we like the fact that you trust us, right? And you go through the ups and downs with us. And we couldn't have had a better investor, right? So that's the thing I think we aspire to be, to build that kind of bond with the founders and help them succeed.
Let's switch gears. More spicy question. Exit strategy. Because obviously, as any investor, you invest into something to sell it hopefully at a higher price. So that's how you generate returns, whether it's for external LPs or internal stakeholders. Given the current environment, right, slightly depressed public markets, how do you balance that sort of hope for a big return, in the long term, right? You have conviction in the founders with the uncertainty in short term, right? Because a lot of things might happen that are completely outside of your control. Tariffs, macro, things that happen outside of crypto, right? Blow-ups, black swan events. With then the need for your stakeholders to say, well, I'm okay with a 3x return or 5x return. I don't need a 100x dream. I'll take money off the table, and returns are money now. How do you balance that? Maybe Akshat.
Yeah, I mean, again,
what is Arthur telling you? Yeah.
As a family office, again, we're very flexible, right? So we don't have any requirements to deploy and then pay back at a certain time frame. I've got one LP, it's Arthur, and I think how you get out is a function of how you get in. So if you get into a deal through a locked round with a 3-year vesting schedule, et cetera, then that's how you're going to get out, right? And if you get in liquid, you can get out liquid. There's also a lot of VCs nowadays in crypto have other revenue streams that are attached to the VC investment. So the venture investment might even be a loss leader. But there's advisory shares. There's we can incubate. There's a bunch of stuff they do to collect fees on other parts of the business. So sometimes venture investing, when you see certain brand names, you're like, oh, it must be, they must really believe in the project, which is true, but they also often really believe in the revenue streams that are attached to the project. They'll benefit other parts of the ecosystem that they have with their business. So there's other ways to get exit liquidity like that if you're an investor in crypto. And then for us, lately we've been pretty excited by equity deals, so not necessarily token deals, but companies that generate cash flows and cash flows stream down to the equity stack. So we've been doing a lot of diligence in that category. With again that later down the road gives you the option of getting paid in dividends. Maybe there's an inorganic exit, someone acquires the company, or a token that gets launched eventually, or a mix of all three.
Victor?
Yeah, so I would say since the new administration in the US, there is a new trend, is that American cash flow generating companies are acquiring our portfolio companies. So a couple of public information, Helio was acquired by MoonPay, another company acquired by MoonPay. There was just announced, I think today, that Ripple wants to buy Circle. And there are a lot of, cash flow generating companies in crypto. Tether is also acquiring. So I would say that's a new trend which I see. So recommendation to founders and other investors right now I would have is don't go into token-only deals. We are token investors, but we invest into equity and we get a token warrant. Because you actually don't know how the exit will happen. And it might be that another cash flow generating company will acquire your team.
Yeah, I mean, we have external investors as well, and so we have to think about distribution. And I would say it is a balancing act, right? Because on the one hand, you want to return capital back to investors, but on the other hand, you want to stick on with your portfolio founders, for as long as you can. So we try to do that as much as we can, and we typically don't invest with the idea that we're going to get out in this cycle, right? We plan for actually the next cycle. So that gives us enough breathing room and gives the company enough time to mature, right? Which is the key thing, to find a product market fit. As I mentioned earlier, we're starting to make distributions now. And we do have the benefit of having made equity investments as well as token investments. I guess the equity exits are maybe a little bit longer, but sometimes easier. Like, for instance, we invested in Circle, and obviously if they do go public within the next 3 months, then that's an easy exit, right, for us. The token investments, I think there's always a misconception in the public arena that, when the moment VCs get their tokens, they dump it. That is, I think, a real misconception. I mean, there are projects where we've had 100% of tokens vested a few years ago, right, 2 years ago, and we have not sold a single token, right? And the reason is because we don't think that the company is mature yet. We think the token can actually appreciate further, right? And when it comes time to sell, we also don't sell everything at one go, right? We typically phase it out over 1, 2, 3 years, because the last thing we want to do is have the token price chart go like this, right? And then people start asking questions, what's going on with this company, and so on and so forth, right? So we want to make sure that when we sell because there's demand, and the tokens go into safer hands, and we'll continue to hold those tokens, and we have a beautiful price chart as a result of that.
Ella, I mean, Easy Labs is famously, I mean, Victor said it, you're long-term holders. But the statement never sell, that also cannot be true. So what is your thinking on sort of exit strategy, short-term versus long-term?
So I think it's impossible for investors saying that never sell, right? So if I say that, that's a lie.
Yeah.
So I think the overall strategy is long-term. Even our liquid strategy, we are not doing high-frequency trading. We are kind of analyze the fundamentals and try to hold the fundamentals. The assets have the good fundamentals for a long period of time. And over the past of 7 years, we see the highest return and yield actually come from the very early project that we still hold today. Our family office, we're relatively flexible. But our principle is, as long as the founders are building, the founders are not front running, we're holding. And sometimes even the projects is in a difficult situation, but founders have a lot of conviction and they need extra capital. We will help to pull in capital to support them to grow. But I agree with Victor on one thing, that we don't only invest in tokens. We invest in both equity and tokens, because there's several lessons learned. There are projects we only invest in tokens and we help them to grow. They exit from the equity side. There's we cannot capture any upside. So now when we typically do equity plus token investment.
Excellent. I guess next question is, you talk about that all the time, but narratives, right? This is in crypto space. This is like it's still a space full of narratives, and narratives come and go, and they change. As value investors ourselves, we don't believe in narratives, right? We need to sort of see numbers and cash flows. But like, it is important here. How have narratives changed for you? What are you most excited about, and what are you saying? You know, those narratives are not that used to be a narrative, and now are really it's a red flag for you. Maybe Akshat, do you have a view here? And
Yeah.
maybe just just help prompt, like, for a long period it was all about infrastructure investing, and now, like, I think there's a consensus that we need to onboard more consumers and institutions on the application side. Like, how has your weighting changed maybe between these?
Yeah. So for us, again, we follow the market, where we are in the market cycle. So in the beginning of the market cycle that we're in now, 2023, we're focused on mostly the infrastructure stack. 2024 got more into apps, especially in DeFi and stablecoins in particular. And now for us, we've done a lot less venture investing, and we've started to look at, I kind of alluded to this earlier, some strategies that are outside of just the standard early token investing model. And one of those things that we're excited about now is the opportunity to potentially do private equity style buyouts in the crypto space, combining playbooks from TradFi and crypto. And there's a few different categories that could fall under. There's some businesses in crypto that are highly profitable, that don't have a token model but should. There's some that are highly profitable but probably are in a very crowded marketplace where there should be consolidation. So roll-up strategies are need of the hour. And then there's some companies in crypto that are doing well, but the current management team, they're great at taking it from 0 to 1, but you need a whole different strategic leadership team to take it from 1 to 5. And those are the 3 areas that we're looking at. We're market mapping pretty intensely right now. We're sourcing deals left and right, and we'll probably hopefully get something done by the end of the year.
Can I ask you a personal question?
Yeah.
So Arthur said on stage yesterday, fuck it, go all in.
Yeah.
So are you guys now all in? Do you have any cash left?
The reason he said that is because he told me that as well. We exited a lot of positions in December and January before Trump took office, and that ended up being a really good decision. A couple weeks ago, he was like, "Let's deploy what we've got." So we're going all in.
Yeah.
But in strategies, as I mentioned, right, not necessarily just token stuff, but also equity.
Kelvin?
Yeah, I think narratives are important, right? Because everything that we're building in crypto is early. And usually, and narratives doesn't mean that there's no fundamentals, right? It just means that it's early. And there are no results or numbers that you can see yet. So you need to weave the narrative so that people get an idea of what the dream and the vision is, right? And because we, through the venture fund, sort of invest so early, typically at the seed stage, where these projects will not have fundamentals yet, right? So we need to find founders that we believe in, right? That have the narrative and the vision to want to build something that could evolve into a billion-dollar, project. So I think it's important, and there's nothing wrong with, sort of narratives. And I think crypto needs to eventually deliver and go beyond the narrative. But the starting point, I think, is okay with narratives.
Ella?
So it's just another name. I think in equity, in NASDAQ, companies do road shows. They also tell stories. And great companies have good stories and good vision. It's just in crypto, we somehow to use narratives. There's nothing wrong with it. So narratives also change, right, from NFTs and memes. And for the next, we see a lot of building towards RWA, stable coins, AI agent, also payments. We definitely think it's probably underappreciated narrative where we can say it's a problems to be solved and the future applications to be built. So I think definitely there's stories or directions we should focus more, but the real thing is what's a problem you're trying to solve, and after solving this problem, what's a good business behind, and what you can potentially create value to benefit the human society. That's a narrative we believe in.
Very good.
I think just maybe to say one thing. like investing into narratives is the best way to lose money.
Yeah.
Because narratives, they come, then they go, and then maybe they come back. Yeah. So, like for example, NFTs, I think are not coming back. AI agents, if you were investing in like December, maybe virtuals at like 0.3, maybe November, AI 16Z at like I don't know what was it like 0.1, then went up to $5 and like to up 0.6, and then now it's like super depressed, like 0.4 virtuals and 14.4 axis. So it's very tough. The better strategy, I think, is to see where the traction is. I think ZK as a narrative is coming back because Ethereum has to shift to ZK VMs to actually fulfill their vision. So, but like fundamentally, if I step back, there are only 3 use cases which really make sense so far. Number 1 is trading. In crypto, in spot and derivatives, we are trading as much per day as Nasdaq. I think that's a great trading use case. And we invested into hyperliquid breakout prop. With breakout, you can pay $500 to test, and if you pass the test, you get $100,000 worth of crypto to trade with. Second use case, which really has traction, is stablecoins, and we are using as much stablecoins as Visa and Mastercard, payments volume per year. Definitely use case, including yield-generating stablecoins like Ethena. And third one is yield on-chain, and I think that's the next step, because we'll have more and more crypto owners, more and more owners of digital assets, and they will want to generate yield on-chain. That's where we are investing now. So we are investing, for example, in reinsurance on-chain to generate 24%. We are investing in private credit protocols like Pareto. We are investing in Fragmetric, Solana staking. So that's, I think, where the value is until the end of this cycle.
Closing statements, we're running out of time. Akshat, one contrarian belief you have about venture investing that others might not agree on stage. Or anyone. Ella, start.
Yeah, you can go ahead.
Yeah, I can talk about ours. I think a lot of people just don't have much conviction in Ethereum. I think we're still bullish on Ethereum. We think Ethereum is a fundamental belief of the next generation of internet. And Vitalik is a very smart and great founder. As long as he doesn't give up, we think Ethereum won't go away and still have the chance to come back. So we are the Ethereum holder and we hold it for long term.
That is contrarian. Yeah, there's some applause here. Good. All right, we need that. Kelvin, anything?
Yeah, I think we will see the revival of the AI narrative or AI agent narrative later this year. I think, obviously they had a big sort of run up in 4Q last year and pretty much gave back everything in the first quarter. But I think we'll have a re-emergence of that theme later this year.
Yeah, without a one. Yeah. I think that purpose-built blockchains, like 95% of them are a VC scam that's going to be pushed on to everyone else.
Upchain. Okay. Viktor?
I would say, just sometimes forget about work. All that matters in life is love. So, love your founders, help them. They'll be successful, you'll be successful.
What a great closing statement. Thank you, guys. We're at time. It was a pleasure.